Ladies and gentlemen, good afternoon. Welcome to Keystar Corporation First Quarter 2021 Results Conference. This meeting will be co-chaired by Peter Chen, our chairman, and Jasmine Hong, our CFO. They are being joined by 5 executives, namely GM of Information Technology Business Group and Commercial and Industrial Business Group, Joe Huang, GM of Medical Devices Business Group, Harry Yang, GM of Business Solutions Group, Michael Lee, GM of Networking and Communication Business Group, April Huang, and Chief Investor Officer, Michael Wang. The meeting will take about an hour. The agenda is as follows. First of all, our CFO, Jasmine, will go over our first quarter results and business highlights. And then our chairman, Peter, will share with you our business update and outlook. Afterwards, our general managers of different business groups will have overview of their respective business group. And then Jasmine will share with you the change made to the accounting treatment of our shareholding of AEO. Then we will proceed with questions and answers. You may submit your questions online, and we will consolidate all the questions we received and answer them during the Q&A session. Before we start the meeting, I would like to remind you that all forward-looking statements contain risks and uncertainties. Please spend some time to read the safe harbor notice on slide number 4. Thank you. Now we will proceed with the presentation. I'll first hand over to our CFO, Jasmine, for an overview of our Q1 financial results. Good afternoon, this is Jasmine. Starting from the third quarter of 2020, we have been holding quarterly results conference, and more investors show increased interest in knowing more about Keystar. So I would like to take this opportunity to go over our business. First of all, Keystar was established in 1984. We were listed in Taiwan in 1996. Ticker number is 2352. We have a capital size of 19.7 billion NT dollars. We have 180 companies under the group, and 14 of them are listed in Taiwan. Today, we have an employee size of about 33,000 people. For our global presence, we have manufacturing sites in Taiwan, China, and Vietnam. We have sales offices spanning in 194 locations worldwide. We have R&D sites in Taiwan and China. In terms of our revenue breakdown by geography, Asia accounts for 46%, Americas 29%, Europe 22%, and others accounts for 3%. Our 2020 revenue was 191.7 billion NT dollars, equivalent to $6.5 billion US. We also have received many awards. In 2020, we won the Best Companies to Work For in Asia Award, and we also won the 2020 Taiwan Corporate Sustainability Awards. For our business overview, we have ICT, Medical, Business Solutions Group, BSG, and Networking and Communication, NCG Group. The Medical, BSG, and NCG groups are our high-value added business groups. In the first quarter, their combined revenue share was 33%, exceeding 30% consecutively and steadily pressing ahead toward the goal of representing more than half of our revenue. Under ICT, we have products such as gaming and high-end displays. This group accounts for 60% of the revenue, Medical 7%. We have 2 hospitals in China, one in Nanjing and the other in Suzhou, established 12 years and 7 years ago respectively. Besides hospitals, we also have equipment, consumables, and dialyzer. Under BSG, which accounted for 12% of our revenue in Q1, we have 6 verticals: hospital, factory, retail, energy, and enterprise campus. We are able to provide end-to-end software and hardware integrated AIoT solutions. NCG accounted for 14% of the revenue in Q1. During the first quarter, we have sharp increases in both revenue and profit, while EPS reached 1.07 NT dollars, up by 0.96 NTD, registering the highest quarterly result in 13 years. Revenue increased by 30%, OP income up by 66%, net income attributable to Kista up by 808%. Q1 used to be a traditional slower season, but due to our strategic investment in high value-added business and increasing demand in commercial and industrial applications for ICT products, we had highest Q1 revenue and operating income in 13 years. Moreover, our gross margin, OP income margin, and net income margin also increased YOY. Gross margin was 14.7%, up by 1.3 percentage points. OP income margin 3.4%, up by 0.8 percentage point, and net income margin 5.1%, up by 4 percentage points. Non-op income continued to make positive contribution thanks to recognition of assets under the equity method and other non-op income contribution. Revenue of our high value-added business was 33% of our Q1 revenue and was up by 92% YOY. On March 23rd, we completed the public tender offer for SciSage, increasing our stake in the company from 35% to 51%. So starting from March 23rd, we raised the percentage of the income recognized for SciSage to 51%. Our board of directors passed the approval to distribute cash dividends for 2020, 1.5 NTD per share, representing a payout ratio of 59%. Quarterly results. Net sales came in at 50.9 billion, up by 11.7 billion or 30% YOY. Gross margin increased from 13.4% to 14.7%, up by 1.3 percentage points. Gross profit increased by 42% YOY. OP income was 1.7 billion, up by 681 million YOY or 66%. Net income attributable to Kista was 2.1 billion, up by 1.8 billion or 808% YOY. For net non-operating income, the number was 1.4 billion, down by 398 million QOQ and up by 1.8 billion YOY, thanks to income recognized under the equity method and non-op incomes. For balance sheet, the numbers stayed similar to previous periods. Debt ratio was 64%. Financial debt ratio was 28%. Total assets increased by 400 million QOQ. AR was down by 5.7 billion. AP was down by 3.6 billion due to seasonality. Compared to a year ago, total assets increased by 39.5 billion thanks to the recognition of Alpha Networks assets, which became a Kista subsidiary in August 2020. Financial ratios. AR turnover was 78 days. Inventory turnover 75 days. AP turnover 81 days. Cash turnover cycle 72 days, up by 2 days QOQ. ROE was 17.4%. Current ratio 127%. Financial debt ratio 28%. Flattish QOQ. Revenue breakdown by business. ICT accounted for 60%, medical 7%, BSG 12%, NCG 14%. As said, the high value-added business accounted for 33% of the revenue in Q1, starting from Q3 2020. Their combined share exceeded 30% for 3 quarters in a row. So for the yearly number, the high value-added share went from 13% in 2018, 16% in 2019, all the way to 33% this quarter. We expect to see more growth this year, and as we continue to press ahead toward making them more than half of our revenue. Next, we would hand over to Peter for our business updates and outlook. Dear investors and friends from the media, good afternoon. This is Peter Chen, Chairman of Kista. Time really flies. Here we meet again for this quarter. In March, in the previous investor conference, I said that I believe 2021 would be a fruitful year for Kista. And we also expect that there will be strong growth in revenue and profit. As you have heard from Jasmine, in the first quarter, our revenue increased by 11.7 billion YOY. Last year, because of the COVID outbreak, the base period in the first quarter last year was lower. But still, for the first quarter this year, we posted highest OP income in many years, even higher than that of Q3 2020. EPS was 1.07 NT dollars. This echoes what I projected in March. That is, with our years-long commitment to high value-added business, we would deliver stronger performance in terms of revenue and profitability, in particular with profitability. We have been committed to value-added transformation, and we want to deliver stronger performance in terms of revenue and especially stronger performance in profitability. We have our team to thank for the strong performance. Although Q1 was the seasonably soft quarter, especially for the medical and several other sectors, Q1 was softer. But still, Kista managed to deliver the highest Q1 OP income for many years, which was quite an achievement. We have our team to thank for that. The results underscore the benefits of our grand fleet of alliances. By leveraging the resources among our strategic partners in the grand fleet, we are able to post strong results despite the negative impact of component supply tightness. So we deliver strong results for the first quarter, but we will not stop here. You may still be very curious about our Q2 outlook. Industry-wise, order momentum is stronger than supply capacity, and raw material prices hikes continue. As mentioned last time, it is essential for companies to have a full set of components. Otherwise, their inventory levels will go up. Actually, many system vendors are facing these challenges, with shortage in several key components despite the availability of other components. So the situation remains unchanged. But for the second quarter, we will be cautiously positive. We still hold positive views for our revenues and profit growth. In terms of industry outlook, Q2 visibility is relatively better than Q1. For the entire year, the second half may present more uncertainties, as many signs have suggested. What's worth noting is an increase in CPI. In April, for example, the CPI in US jumped by 4.2%, whose impact on the quantitative easing policy will have to be observed. Moreover, raw material prices are increasing, the cost of which will all be transferred to consumers ultimately. We have to cautiously consider consumer demand as there are so many uncertainties. So it is going to be more challenging for companies to manage their operations and ensure good performance in the second half. But at Kista, We will continue to scout for potential strategic partners that can be part of our grant fleet. In the second quarter, we just added 2 more members to the grant fleet. We hope that through expanding the alliances, Keystar will continue to improve our revenue and profits and have our high value added business to contribute more to our revenue and profits. So that is our general direction, which will remain unchanged. So from the perspective of Q2 or for the entire year, because we have the grand fleet of alliances, today we have been getting more and more interests and attention from potential partners. Many come to us, approach us in hopes of joining our grand fleet. They hope that we can grow together and to go further and longer together. Because of these proactive measures that we have been taking, we are confident that we can overcome all the uncertainties that the second half may bring upon us. Through the proactive activities, by working with our grand fleet partners, we hope that we can continue to lead the industry to solve the existing challenges. I would also like to ask for your support. We will continue to deliver results and strong performance. Thank you. Now we will have our executives from our 4 business groups to provide overview of their respective business. First, we have Joe. Good afternoon. This is Joe Huang, GM of Information Technology Business Group and Commercial and Industrial Business Group. In Q1, the demand continued to be strong. However, there were the restrictions coming from supply tightness for semiconductor and panel products, as well as a drop in cargo capacity. However, our display and projector revenue as well as shipments were still better than last year. In Q2, the demand is still strong, but the supply from semiconductor products and the capacity of cargo and transportation is even stricter. So supply has been disrupted. YOY-wise, sales growth may not be as good, but as we continue to provide high-end products and focus on high-end products, we can still expect growth. Looking ahead at the future, today market demand is not being fulfilled fully, so we continue to be positive about the full-year prospects. With the $1.9 trillion USD money being injected into the market, we believe that the market will be given a further boost. However, given the restrictions coming from IC and panel supply tightness and also a restricted capacity of cargo, the sales growth may be contained, but we maintain our cautiously positive view. Next, I'm Harry. I'm the head of the medical business. I would like to take this opportunity to go over our business. We have been investing in the medical industry for 15 years. Currently, we have 15 medical companies under our umbrella, as well as 2 general hospitals. Actually, we have 3 leading brands in the market: consumable brands, Lilly Medical, and ethanol solution brand Golden Spirit. Especially with the ethanol solution, we hold 80% market share in Taiwan. And we also have hearing aids, which is also one of our leading brands. For dialyzers, we can provide end-to-end services covering products to channel services. We are also investing in smart medical, including smart hospitals, OR, dialysis center, and solutions. In the ICT industry, we have the deepest and widest footprint in the medical sector, covering 4 fields, ranging from hospitals to equipment and consumables, which include surgical lights and ultrasound, etc. We also have cosmetics products ranging from equipment to beauty products. In terms of solutions, we have smart medical and operating table, dialysis center, and dentistry solutions. In Q1, our sales were better than expected, and the growth also exceeded our expectations. Currently, we are working to optimize our existing business, and at the same time, we seek to look for M&A targets in hopes of expanding our scale. For Q2, today we already have a good footprint in terms of dialysis channels, and we will continue to see growth in China and Southeast Asia. Given the virus control demand, currently the market demand for face masks and ethanol solutions is huge. We will gear up our production to meet the market demand. So looking ahead at the second quarter, we are cautiously positive, and we expect the results will be better than expected. Hi, this is Michael Lee, GM of BSG. I would also like to take this opportunity to go over our business. BSG focuses on providing enterprise-level IT plus OT digital transformation solutions. We have 3 segments. One is equipment, focusing on industrial, financial, and cybersecurity solutions. We also have distribution business, working on providing IT plus OT integration services. The third part of our business is especially targeting SIs and SPs. In Q1, on the back of rising digital transformation demand, we took the opportunity to sort through our investments and sold some of our distribution entities. In terms of our device business, because of the supply tightness of certain components, the sales was worse than expected, but we expect to see some offsetting in Q2. In terms of distribution business, because today companies are moving from on-prem to cloud services, so we are seeing an increase in our revenues. While our on-prem solutions revenue has dropped, but we expect to see an increase in our total profit. As for our overseas footprint, we are increasing our presence. We work with startup companies to push forward digital transformation. For example, we recently worked with Just Kitchen, which is seeking listing in Canada. We work with this company and hope that we can help more startups to seek overseas listings. Good afternoon. This is April Huang, head of the NCG. The Networking and Communication Business Group, or NCG, is headed by Alpha Networks and also consists of Hytron as well as the system integrator under Hytron, which is IDT. Now I would like to use a bit of time to share with you our Q1 results and our Q2 outlook. During the first quarter, due to component supply tightness, our revenue was impacted negatively. However, given a lower base period last year, our Q1 revenue still went up by 44% YOY, of which Alpha Networks was up by 24%, Hytron up by 94%. In Q1, NCG's profit also increased YOY, with an EPS of 0.21 NT dollar compared to the negative 0.24 NT dollar last year. As for the second quarter, currently order stream is quite strong. We have visibility up until Q1 next year. However, the uncertainties caused by supply tightness may still be here with us. The increase in our costs will be shared by our customers, thereby improving our gross margin. Besides our original business, we must also ensure that we have allocation of all the components to make sure that we can grow our sales. We will also be leveraging our existing channels to develop new businesses. Currently, Hytron is leveraging resources from Alpha Networks to launch new product lines, which will be shipped in Q2, and currently more products are being developed. In terms of the new product expansion of Alpha Networks, we also see results coming up. In terms of 5G, digital multimedia, and automotive solutions, we all have new projects being developed, which will be able to support our further development. Next, we will have Jasmine to share with you the change in the accounting treatment on investment in AUO. Good afternoon. On May 11th, we unveiled a press release. It's about changing our accounting treatment on investment in AUO. You may refer to slide 28. Here is our press release. And for more details, please turn to slide number 27. In the past, we recognized the investments in AUO under the equity method, so we have to recognize the loss or profit of AUO based on our shareholding percentage. Because the panel industry's P&L is very volatile, so it has had some significant impact on our non-up performance. So it has caused our investors unable to see clearly our results. So we want to eliminate the uncertainties from recognizing the share of AUO's profit or loss in our non-op activities. Starting from May 12, 2021, Kista changed the accounting treatment on investment in AUO from the equity method to fair value through other comprehensive income, or FVOCI. What does this signify? This means that starting from May 12, 2021, Kista will not recognize AUO's profit or loss by its ownership percentage each quarter, meaning that the profit or loss of AUO will no longer affect our profitability and EPS. Secondly, the investment in AUO is measured at fair value each quarter, with the resulting change in fair value represented in other comprehensive income. As a result, such resulting change in fair value would not affect Kista's net income and EPS each quarter. For every year, if AUO issues cash dividends, Kista will recognize it as dividend revenue under non-op activities, and such cash dividends will increase Kista's non-op income and EPS. So this is what we will do in terms of recognizing the loss or profit in our investment in AUO. Under IAS 28.22, the one-time valuation gain resulting from this change in accounting treatment will be recognized under non-op activities in Q2. So during April 1st and May 11th, Kista recognized the share of profit or loss from AUO by our ownership percentage under the equity method. And from May 12th, under IAS 28.22, one-time valuation gain resulting from change in accounting treatment will be recognized. What does this mean? In Q2, we will calculate the closing share price of AUO on May 11th minus Kista's cost of ownership in AUO times the number of the shares of AUO that Kista owns. The result will be an estimated total amount of 2.4 billion, but the final amount will still be finalized after CPA audit. We have more details here to help you understand our calculation. As of March 31st, Kista's share cost of AUO was 20.56 NT dollars, and we owned 663 million shares of AUO. On May 11th, the closing stock price of AUO was 24.2 NT dollars. So the estimated amount will be 2.4 billion NT dollars, achieved by having the closing share price 24.2 minus cost share price 20.56 and times 663 million shares. This will be separately presented under shares of profit of associates and joint ventures and gain on disposal of investment in the statement of comprehensive income. But the total amount of these two items will be made public only after CPA completes Q2 assessments. However, we expect the total amount to be roughly 2.4 billion NT dollars. The next slide is the news release that we released on May 11th. Now we will proceed with questions and answers. You may submit your questions online. In the interest of time, we will consolidate the questions and answer them all together. I think there are many questions about the change in the accounting treatment on our shareholding of AUO, and also whether this will affect our partnership with AUO. Hi, this is Peter. First of all, once again, thank you for taking part in our results conference despite the rising COVID risks. People are very curious about why we make such a change. The reason is actually quite straightforward and simple. In the past few years, whenever we had our shareholder meeting, there was always some investors asking us about this question. The ultimate reason is that AUO's capital size is 96 billion, whereas ours is 19.6 billion. So their capital is almost 5 times larger than us. This is because of the characteristic of the panel industry. The panel industry has lots of ups and downs. They can make a lot of money, but also lose a lot of money. So the volatility is quite significant across the industry. Because of the difference in the scale of the two companies, especially the capital size, we are under a lot of impact. So many shareholders were quite concerned about this situation, and I have told investors that we would find the right time and right situation to make appropriate adjustments. So this time, we identified the appropriate timing to make the adjustment. So the reason is actually that simple. Because we want to really be able to reflect our own fundamentals, to make sure that we can showcase to you our value transformation results, rather than being affected by the income recognition under the equity method. So we want to be able to present our results post-value transformation. In the past, people often thought of us as a display business concept stock. But if you look at our Q1 results, if you look at the performance of our new businesses such as AIoT, NCG, and Medical Group, you would know that their combined share accounted for 33% of our revenue, up significantly YOY. And similar with the 34% of share from Q4 2020. But if you look at the YOY growth, you can see the growth has been very strong. We have announced that we hope we would make our high value added business to account for more than half of our revenue by 2022. That is our goal. As I said last quarter, we stand a chance to realize that goal this year or come very close to that goal this year. We no longer are just a display business concept stock, although we still perform really well with our display business. But at the same time, we are delivering stronger performance for our high value added business. And that is why the profit or loss from AUO will have less impact on our income statement. Instead, it will be reflected on our balance sheet. As Jasmine just shared with you, we hope that through this change, we will be able to show to you the results of our value transformation efforts. As far as our cooperation with AUO, it will still be the same. We are belonging to the same group, and we have built collaboration experience and partnerships over a very long period of time. So the relationship between the two companies will not change. Please be assured. We only made adjustments to our accounting treatment on the shareholding of AUO, but our relationship will not change. Thank you. This question comes from analyst surname Chen. The question is whether the stock price of AUO have any bearings on our balance sheet. This is Jasmine Hong. Please turn to slide number 26. We said that for every quarter, the investment in AUO will be measured at fair value with the resulting change in fair value presented in other comprehensive income. So the resulting change in fair value would not affect our net income or EPS every quarter. Also, there are other questions about the sources of revenue growth. What are the sources which business group accounts for more gross margin growth, and what are the outlooks for revenue and gross margin changes going forward? This is Jasmine. In terms of revenue, we have a growth of 17.1 billion YOY or 30% YOY, mainly because of our proactive action to have merged Alpha Networks. We have an increase of 7 billion NTD, and also our medical business also grew by 60%. Moreover, our ICT business increased by 11%. We just shared that our BSG revenue declined by 9%. It was because of the fact that we sorted through some distribution business. Secondly, of all these four business groups, what are the performance comparisons in terms of gross margin and profits compared with the same period last year? Actually, gross margin has been quite good. BSG gross margin was quite strong across all the business groups. The performance of BSG was flat, but in terms of their contribution to our profit, they continue to increase their contribution from the high value added business, and we continue to press ahead toward making our goal to have high value added business to account for more than half of our revenue. For Q2, actually we have unveiled our April revenue. Revenue was up by 20% YOY. For the first 4 months, the revenue was up by 25% YOY. So we expect to see double-digit growth in our revenue in the second quarter. We also expect that our operating activities to continue to make positive contribution to our profits, plus the fact that we have changed our accounting treatment on investment in AUO, so we continue to hold positive views for our Q2 performance. The next question is about our BSG, whose revenue went down by 9% in Q1 YOY. So the question is about our perspectives on its growth this year. How can we ensure that our BSG solutions spanning across 6 different verticals, how can we make sure that we manage our synergies effectively? In Q1, we were affected by supply tightness of components So we were unable to deliver our products, our device products as expected, but we are resolving that in Q2. So we expect to see YOY growth. Under PSG, we have mostly listed companies. And secondly, we also have our distribution business, mainly consisting of ACE and AWIN. In terms of industrial applications, we are seeing growth. In terms of IT, we have sorted through our investees, and currently we are focusing on cloud applications. As for the future, for the next 5 to 10 years, the cloud business will account for over 50% of the business. So we are taking this good opportunity to sort through our business. We are making significant investment in software and service talents. Yesterday at the investor conference of SciSearch, we announced that we now have a staff size of about 300 people. In addition to just kitchen, we are also working with My Warm Day and Ba Fang Dumpling, which have been recently listed. They have close collaboration with us. Our biggest contribution to the industry is assisting non-IT companies to pursue digital transformation and improve their performance. On this regard, we have good responses from our customers, and we are enjoying a very high retention rate. So we are very positive about our future growth. The next question comes from analyst surname Liu. Chairman, you said you were more conservative about the second half outlook. Which business group makes you more concerned? Thank you for your question. The reason that I said that we have to be more conservative about the second half, it was not actually just about Kista or a certain business group of ours. It was just an observation made for the entire industry for the macroeconomic conditions. It is because that currently COVID situation is still very serious, and many countries such as India is having trouble containing the spread of the virus. We don't know whether the future will hold, and we don't know whether vaccination will proceed successfully and smoothly. And there's so many different variants coming up. Today, the world is really flatter. When a country is not controlling the virus spread effectively, then it will throw a wrench in the global economy. And also, all the prices are increasing, and ultimately it will come down to changes and increases in price for the end consumers. Moreover, we have the inflation increasing. As I said, in US, CPI index increased by 4.2% in April. According to Fed's definition, whenever CPI increases by more than 2%, it warrants attention, and it warrants a reassessment of whether to continue with easing policy. This is why I said that we cannot be overly optimistic about industry conditions for the second half. Currently, we hold cautiously positive views for Q2 prospects. But when it comes to the second half, I think we shouldn't be overly optimistic. This is because of the factors coming from the macroeconomic conditions. Last time at the investor conference, I also said that supply tightness of components is very serious, but it all boils down to the supply shortage of key components, especially semiconductor components. Many companies could not get a full set of components needed. For example, for TV sets, projectors, or displays, you need to have hundreds of components or parts. Sometimes you just wait for 2 or 3 components, and it has it disrupts all of your supply. So for manufacturers or for system vendors, whenever there's a shortage in those key components, their inventory levels build up. And making it worse is that the raw materials or components are already increasing in pricing. So what if one day the overall market demand declines? The supply chain will take a hit. So I'm saying this from the perspective of the macroeconomic conditions. I hope that everyone can take proactive action. What it means is that we have to make prudent control of our inventory levels. We cannot afford to be overly optimistic. When there's double booking, situation may worsen when inventory levels are being digested. Kista has spotted this trend early on. We have taken preventive measures, and we will continue with what we are working on. And going forward, we will also accelerate our speed of adjustment. So I'm taking this opportunity to share with you our perspectives. But as far as our own performance, we are relatively optimistic. This is because we have the grand fleet, the grand alliances with strategic partners. So compared with companies that have to work independently, we are relatively better prepared. Thank you. We have questions on the increases in raw material and transportation costs. Analysts are interested in knowing whether this will affect our profitability, whether we are going to reflect the price hikes on our product prices. Do we have any shortages in terms of the supply of scalar IC? Hi, this is Joe, GM of the ICT group. In terms of the supplies availability of scalar IC, you can examine it from three perspectives. First of all, if you cannot fulfill all the orders, then of course you have a supply shortage. And secondly, you have to know whether you have sufficient availability of panels. Thirdly, if you have some panel supplies, but what if you don't have sufficient scalar IC, you don't have a match between your panel supply and scalar supply, then you will still be affected. We also have questions about our changes in the recognition method on our investment in AUO. So, and the analyst asked that by one-time valuation gain, do we mean 2.4 billion NTD of income? This is Jasmine. My answer is that during April 1st to May 11th, Kista will recognize AUO's profit or loss under the equity method. On May 12th, we will recognize the one-time valuation gain resulting from the change in the accounting treatment. The estimated total amount will be 2.4 billion NT dollars. So the next question is about our presence and our strategy for the autonomous vehicles. What are the progresses that we have been making? Hi, this is Peter. When it comes to autonomous vehicles, our group has been making many investments. For example, we are a member of the MIH platform. Several of our subsidiaries, such as ACE Pillar, is deploying and implementing the channel-first strategy. It is distributing a rapid charging stock from a European vendor, and it is also working with other brands to bring in the charging stocks into Taiwan, and the results have been showing. Currently, we're working on selling and promoting the services. So when it comes to our solutions from medical to autonomous vehicle solutions, we implement the channel-first strategy, meaning that we focus on investing on channels first. We try to understand our customers' and users' demand and try to fulfill the unmet demands in the market so as to capture the potential values. So when it comes to the implementation of channel footprint, As long as we identify business opportunity, as long as we identify the most valuable part of a new industry, then we will take action. So in terms of autonomous vehicle solutions, we also are leveraging this channel-first strategy. We are quite positive about the development of this technology because in the next 5 to 10 years, we think autonomous vehicle technology will really accelerating. It also is a very good opportunity for the ICT industry of Taiwan. Taiwanese suppliers have already played a very important role in the Tesla's supply chain, and the percentage of ICT products is much higher than in autonomous vehicles than other vehicles. So from our group's perspective, we will continue to implement the channel-first strategy and to help the business to expand quickly. We will start from the channels, then we will drive the fast adoption of the autonomous vehicles in Taiwan. So we are hoping that we can play a more important role in the value chain, and the channel-first strategy will be our key principle in terms of the development of the value chain. Thank you. The following question comes from several investors. The question revolves around our M&A direction and plans. And there's also a question on the gross margin on some companies, because some companies' gross margins are lower than the group's performance. How do we make sure that we can achieve our synergy? Hi, this is Peter. Thank you all for your attention and support to Keystar. I think you can keep paying attention to observe whether we can deliver stronger performance in terms of gross margin and net income margin. I think you will be able to see that we deliver evidence that shows we continue to deliver strong performance. The most direct evidence is that over the past 7 years, we've been focusing on value transformation, and as you can see from our Q1 results, our gross margin, our net income, and non-op income all improved. We have had many opportunities to review our existing businesses, whether we are moving toward delivering on the value transformation commitment. For the past 6 and 7 years, we've been doing a good job. When it comes to new business, some investment targets that we had less than 20% in gross margin. But in fact, the reason that we still decided to make such investments, let me give an example. In terms of SciSearch, for example, SciSearch is a distributor for international brands of software. It is part of our channel-first strategy. The reason that we still invested in SciSearch, despite the fact that gross margin at the moment was only 10+%, it was because that for AIoT to really achieve the maximum value, software is essential. And moreover, we understood that customers or users had unmet requirements. Although distribution of software products is very valuable, if we can add on to that, if we can add consulting and services to the value chain, then we believe we could improve the margin. Because the value added has been increased. That is why we are also working on merging some consulting firms. I think you can expect greater things from SciSearch as we continue to work on expanding its services. Also, when it comes to services, we are also working on improving the value adds. So we remain committed to our direction, and we hope that we can improve the margin gradually. Sausage has been part of our Grand Fleet for a little more than a year, and compared with last year, its gross margin has already improved by 2%, and we believe gradually we can achieve a 20% gross margin target. Of course, we cannot go over one subsidiary after another here, but I think the answer is quite straightforward. For some investees that we included into the Grand Fleet, whose gross margin was less than 20%, we still decided to invest in such companies because we valued the future potential of development of these companies, and we believe that they can help us to improve our value-added business. Thank you. The next question comes from analyst surnamed Wang. Could you tell me about your collaboration with Just Kitchen with BSG? Do you expect the collaboration model to also be replicated on other startups? We have Michael to take this one. Thanks for the question. In terms of startups, I think we can divide the business into back office and front office. Startups generally lack experience with back office. Just Kitchen is quite special. It was founded just less than 2 years ago. We helped them to build out their back office services and solutions. We helped them to create a process from order to back office kitchen to food delivery. We hope that in the future, as companies shift toward the cloud, we want that the startups can only focus on the front end and leave the back end to BSG. They can leave their MIS or IT department service to us. This kind of business model can be incrementally replicated to different companies. For example, some existing old brands, they can come to us and have us help them build out their IT systems and help them pursue digital transformation. This is the last question. Could you tell me more about the listing plans of your hospitals and also the development direction of your hospitals? Hi, this is Peter. In terms of the business of our hospitals, here's our overview. Starting from the fourth quarter of 2016, we have been enjoying healthy operations of our hospital business, meaning that we are making profit. Because we're talking about hospital business, we don't want to be solely about making money. That is why we say that it is running very healthily. Since the fourth quarter of 2016 to last year, we have been enjoying healthy operations results. It is quite a feat because for a Taiwanese-owned company to operate hospitals in mainland China, it is quite difficult, and we are one of the top companies there. Last year, despite COVID, we still deliver strong revenue and profits for the hospital business. In the second half of last year, we regained rapid growth in terms of revenue YOY, and this year we expect the growth to pick up. It is especially so with our profits in the second half of 2021. We believe the contribution from our hospital business will be even stronger. As I just shared with you, we have been making profits for 4 years in a row. So it is not difficult for us to go public. And we have already meet the criteria for doing so. But considering the political and economic conditions in where we want to go public, we are not going public just for IPO's sake. So we have to find the most appropriate timing. So please rest assured, because we are running our business quite healthily for the past 4 years, and we are growing faster at the moment. We want to build a business service supply chain across Greater China region and Southeast Asia, leveraging the resources, the talents in Taiwan, and our hospital management competence, as well as our experience in terms of our national health insurance, to really deliver stronger results and to showcase our technological competence around the world. A lot of people are asking where the next growth engine of Taiwan will come from. I think the medical business, the industry, will likely be the next growth driver of Taiwan's economy. Kista has been a frontrunner in terms of the ICT industry when it comes to building presence in the medical business. We hope that we can lead the entire industry in Taiwan to become the next growth driver of Taiwan's economy. So we will work very hard to achieve this goal. Thank you. Ladies and gentlemen, thank you all for your participation. This concludes the investor conference of Kista